to be financially literate. Everything you need to know. We all know how important financial literacy is, but did you also realize that it's a skill most people don't have? Don't worry though, this is Capitalist Domain and we're here to help you make the most out of your hard-earned money. In this video, we'll cover everything you need to know about financial literacy, from the basics of money management to more complex concepts like investing, debt, and liability. First things first, what exactly is financial literacy? Financial literacy is the ability to understand and use financial information in order to make sound financial decisions. It's a critical skill for anyone who wants to be financially successful. Yet, according to a study by the Financial Industry Regulatory Authority in 2018, just 30% of Americans could pass a basic financial literacy test. That's a problem because in order to make good decisions about your money, you need to understand financial concepts like interest, inflation, and risk. You also need to know how to manage your money. That includes everything from creating a budget and sticking to it, to knowing when to save and when to spend. Because personal finance is a complex and ever-changing topic, it's important to have a basic understanding of the concepts involved. Without this knowledge, it can be easy to make costly mistakes with your money. Financial literacy is important for several reasons. First, it can help you make better decisions with your money. If you understand how personal finance works, you're more likely to make smart choices about things like saving for retirement or investing in a new business. Second, financial literacy can help you avoid debt. If you know how to manage your money, you're less likely to find yourself in a situation where you can't afford your monthly payments. Lastly, financial literacy can help you grow your wealth. If you have a good understanding of personal finance, you're more likely to be able to save money and invest it wisely. This can lead to more money in the bank and a brighter future for yourself and your family. Now that you know the importance of financial literacy, let's talk about some of the things you need to understand in order to be financially literate. The key to managing money is in understanding where it's coming from, how much you need for expenses, and your financial goals. It also includes creating a budget that remains true to your spending habits and tracking progress to make sure that you're on the right track. To put it simply, a budget is a plan for how you'll spend your money. It should take into account your income, your expenses, and your financial goals. To create a budget, start by tracking your spending for a month. This will give you a good idea where your money goes every month. Once you know where your money is going, you can start making adjustments to ensure that your spending aligns with your financial goals. For example, let's say you want to save up for a new car. You'll need to make sure that your budget includes enough room for savings. To do that, you might need to cut back on other expenses like eating out or going to the movies. Once you've created a budget, it's important to stick to it. That means being mindful of your spending and making adjustments as necessary. If you find that you're consistently overspending in one area, take a closer look at your budget and see where you can make some adjustments. Keep in mind that financial literacy isn't just about understanding numbers and figures. It's also about knowing how to manage your emotions when it comes to money. That's because our emotions can play a major role in our financial decisions. Another key aspect of financial literacy is understanding interest. Interest is simply the cost of borrowing money. It's important to understand this because it can have a big impact on your finances. For example, let's say you have a credit card with $1,000 balance and an annual percentage rate of 18%. That means if you only make the minimum payment each month, it will take you almost 30 years to pay off the debt and you'll end up paying more than $5,000 in interest. On the other hand, if you're able to pay off the balance in full each month, you won't accrue any interest. That's why it's important to understand how interest works and to avoid borrowing more money than you can afford to pay back. Another important concept is inflation. Inflation is simply the rate at which prices for goods and services rise over time. It's important to understand this because it can have a big impact on your purchasing power. For example, let's say you have $100 today and inflation is running at 3%. In 10 years, your $100 will only be worth $77 in today's dollars. Inflation can also impact your investments. For example, let's say you invest in a stock that pays a dividend of $1 per share. If inflation is 3%, then the real value of that dividend will be reduced to 97 cents over time. Risk is another important concept to understand. This is simply the chance that an investment is going to lose money. All investments carry some risk, but some are riskier than others. For example, stocks are generally considered to be more unstable than bonds. That's because stocks can go up or down in value, while bonds tend to offer a steadier return. Of course, even bonds can lose money if interest rates rise. That's why it's important to understand the risk of any investment before putting money into it. When it comes to investing, there's no one-size-fits-all approach. The best way to invest depends on your individual circumstances and goals. However, there are some general principles that can help you make smart investment choices. The first principle is to start early. The sooner you start investing, the more time your money has to grow. For example, let's say you start investing at age 25 and you put $200 into an investment that grows an average rate of 8% per year. By the time you're 65, you'll have almost $1 million. The second principle is to invest regularly. This means putting money into your investment on a regular basis, even if it's just a small amount. For example, let's say you start investing $50 per month at age 25. If you continue doing this until you're 65, you'll have almost $300,000. The third principle is to invest for the long term. This means taking a long-term view and not trying to time the market. For example, let's say you invest in a stock that goes down in value shortly after you buy it. If you sell the stock, you lose money. However, if you hold on to the stock for the long term, there's a good chance it will eventually rebound and you'll make more money. The fourth principle is to diversify your investments. This means spreading your money across different asset classes. For example, instead of investing all of your money in stocks, you might want to invest some in bonds and some in cash. Assets and savings are also important concepts. An asset is simply anything that has value. For example, your home is an asset, so is your car. Savings, on the other hand, are money that you've set aside for a specific purpose. For example, you might have savings for a down payment on a house or for retirement. Both assets and savings can be used to grow your wealth over time. For example, if you invest your savings in a stock that goes up in value, you'll end up with more money than you started with. Similarly, if you use assets to generate income, such as by renting out your home, you can grow your wealth over time. Furthermore, it's also important to understand taxes. Taxes are simply the government's way of collecting revenue. They're levied on everything from income to purchases. And, depending on where you live, they can have a big impact on your finances. For example, let's say you live in a country with a high income tax rate. That means a larger portion of your income will go to the government in taxes. As a result, you'll have less money to save and invest. On the other hand, if you live in a country with low taxes, you'll have more money available to grow your wealth. Of course, it's important to remember that taxes are just one factor to consider when deciding where to live. Cost of living, job opportunities, and quality of life are all crucial factors to consider as well. Meanwhile, debt and liability are often confused because they both have to do with money. Liabilities such as car loans or credit cards typically come at a cost but reduce your freedom in case something bad happens. Debts usually don't, unless you're already struggling financially, which can lead into more problems down the line if left unchecked for too long. It's important that we know how these two concepts differ from one another. This will help us determine what our best course of action should be when faced by an unusual situation where we're not sure what to do. In general, you should try to avoid debt. This is because debt can be very costly and it can limit your ability to achieve your financial goals. For example, if you have a lot of debt, you might not be able to afford to buy a house or save for retirement. There are, however, some situations where taking debt can be a good idea. For example, if you're able to get a low-interest loan to invest in a business that has the potential to generate a lot of income, the debt can actually help you grow your wealth. Of course, this is a risky strategy and it's important to make sure you understand the risk before taking any debt. Financial literacy is a lifelong commitment. You can't just take one lesson and be done with it. These principles are the building blocks for much of what you'll learn about money and finances throughout your life. So make sure to keep learning and expanding your financial knowledge. It's never too late to start. No matter how old you are or how little money you have, You can always benefit from learning more about personal finance. So, get started today and make the commitment to become financially literate. If you found this video helpful, be sure to subscribe to our YouTube channel for more great contents like this. And if you have any questions or suggestions, feel free to leave a comment. Stay tuned for more videos that will help you understand and manage your finances.